Welcome to my channel. I'm the cover call guy, and this topic is going to be on NEOS funds. Before we get started, legal disclaimer: this content is for informational and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please always do your own research and consult a licensed professional before making financial decisions. I'm just some random idiot you found online, and I could be completely wrong. All right, with that out the way, today's topic is going to be: why does everyone seem to love NEOS fund and what makes them so great? As you know, for those who are new, I'm an income investor using only cover call ETFs. So for those who are on the same journey as me, trying to retire on income ETFs, I'm in my early 30s and I plan to fully retire, hopefully within before 35, if not then before 40 or at 40. And when I've been doing my deep research and got into the rabbit hole, we always seem to find NEOS in the spotlight or the top 3, and I've always wondered why, right? I feel like NEOS has came out of nowhere, right? They did have a great cover call ETF, their SPYI, but that wasn't really like popular. And then when QQQI came out, it just seemed like all of a sudden this fund just boomed in popularity, and just it's been a talk of every single income slash even traditional investing. Like, you must have a piece of NEOS, whether it's SPYI, QQQI, or the Russell 2000, or the real estate ETF. It just seems like they got a stranglehold on the financial community. So again, I did a deep dive on another one on why NEOS funds seem to be doing so good and why everyone seems to love them. Let's get started. Let's see. Let's make the screen bigger. All right. So I'm gonna name this the Gen 3 Advantage NEOS funds and the new cover call strategy. I'll explain more and why I named this the Gen 3 Advantage, and why it seems to be working so well, and why it seems to be pulling in a lot of investors like myself into these ETFs that they hold. The equity income trilemma. The high yield, right? The core demand from income investors: high, consistent, and monthly distribution. Capital growth, the need for NAV preservation, and the ability to participate in market upside, and tax efficiency. The risk of high yields become phantom yields destroyed by inefficient tax treatment. So it seems like NEOS has got all 3 combined, where it gives you the high yield, it lets the stock grow, and is very tax efficient. It seems like they have got all 3 trifecta in and locked in, and it seems like they are executing their strategy quite well. So that's why I think NEOS has really garnered a lot of support and almost a cult-like mentality around it. I'm starting to believe it myself. Again, I am very skeptical of things, and I do own their crypto BTCI and SPYI and QQQI. Not a large portion. I will be scaling those out, but it seems like they're doing quite well, and I really do like what they offer: the high yield, capital growth, and tax efficiency. So I'll continue to keep an eye on it and continue to buy the dips, and as the market goes up or down, if it goes down, I'll buy more. If it goes up, I'll nibble and reinvest. The evolution of equity income, right? We have Gen 1, the QYLDs, right? These are the one that is just gives us the bad rep, and I guess that's why cover calls, if you watch my previous videos, cover calls had a bad rep because of these Generation 1 cover call ETFs, right? Their strategy was literally 100% at the money overwrite, and it gives you a lot of money, gives you a lot of payout, the high yield. But the problem with this is severe NAV erosion and forfeits all upside. Then we have the Gen 2, right? The JEPQ, the JEPBs, right? They were a little bit more better. They were a little bit more solid and have a better foundation. Their strategy was active hybrid via equity linked notes, ELNs. The problem with them was, especially JEPQ and JEPI, they had high tax drag and counterparty risk. And then NEOS came along, and I consider them Gen 3, the newest kid on the block, the newest and ever changing. Their strategy was a more holistic total return approach via call spread. The solution it solved for tax alpha, NAV growth, and high yield. So it solved the problem that Gen 1 had and Gen 2 had. And it seems to be working quite well right now. It seems to be holding up. Again, we haven't been in a prolonged bear market, so we have to see how long it actually does. Everyone does well in a bull market, so we have to see how it does in an actual bear market. Claims from the source, right? The prospectus. We always read that from every ETF. That prospectus tells you what the fund manager, the ETF is going to do and how to execute, and they tell you their plan, right? All right, so true index replication, good, very good. I love that, right? The prospectus confirms investment in the individual constitutes of the S&P 500 and Nasdaq, not a separate ETF. Net credit call spread. The strategy is defined as a mix of written sold call options for income and long bought call options to define upside. Good, very good. That way we have we capture some capital appreciation for the NAV. Section 1256 contract explicitly states the use of broad-based index options, SPX and NDX, which receive favorable 60/40 tax treatment by law. Excellent. I want to keep as much money as I can. I don't want to give it to the IRS. It is a data-driven strategy, describe an active data-driven approach to selecting strikes, optimizing for income upside based on market volatility. So again, good. They are keeping up with the trend, with the news, and they are making sure they have informed decisions when writing these calls. Flawed structure versus the NEOS engine, right? We have the flawed predecessors, such as I mentioned Gen 1 and Gen 2, right? Gen 1 was just straight up like a bulldozer, right? Get me the money, don't worry about everything else, but at the same time they're destroying everything in their path, aka their NAV, and not capturing anything in a rising market. And then we had Gen 2, which is example that I used was JEPQ. It uses ELNs for option exposure, introducing counterparty risk, liquidity risk, and a high inefficient ordinary income stream. So yes, it can grow the NAV capital appreciation, but it didn't have that tax efficiency. And it offered a decent yield, yes, but it didn't have that tax efficiency. And then we have the NEOS structure, right? True index replication holds individual index stock, not an ETF, allowing for tax loss harvesting and on single positions. They also use a net credit call spread, which sells calls for input but also buys out the money calls, creating a defined window for upside participation and NAV preservation, right? That is what we want. We want the trifecta. Then we have to deconstruct the NEOS engine, right? True index replications, it holds individual stocks like Nvidia, Apple directly. This avoids a layer of fees and enables tax loss harvesting single positions. The net credit call spread, the core strategy, sells index calls for income, buys further out the money for upside. This defined upside participation window. And data-driven management just means actively adjust strike based on volatility. So they're always on the market. They're always keeping the eyes on the news, events, and anything that could affect their single holdings strike prices. So they know how to select these strike price. All right, and then it also solved NAV erosion, right, and income capture. Again, this is just a illustrative graph. I'm showing you that everybody starts off at 100. Sorry for the, I had a brain fog here. If you started with like $100, right, and you see the green is obviously NEOS ETF, and then going against Gen 1 and Gen 2, which just lags behind. And then we always gotta talk about the total return, right? Cover call ETFs hold a lot of importance on total return. SPYI versus JEPI 2023, right? NEOS SP 500 SPYI generate a total of almost 20%. There was nearly double total returns of primary Gen 2 competitors like JEPI, right? And QQQI versus peers. NEOS Nasdaq 100 fund, QQQI, delivered almost 43% since inception. This contrasts with the annualized inception returns of JEPQ, about 17%, and QYLD about 8%, right? So it just demolished them, it completely destroyed them. And then I want to say this is the smoking gun data, right? The 1-year NAV return, SPYI was about 17.83, and versus the SPY bench 17.48. So it beat the actual underlying, which doesn't really happen. Beat the actual growth stock, which typically doesn't always happen. So when it does, it is actually a very, very good like it's outstanding. Like it typically an income stock is not supposed to beat the growth. Outperforming the benchmark for the 1-year period ending October 31st, 2025, SPYI outperformed its own benchmark, the SP 500, right? And those people that say buy growth, well, the income ETF got me paid and had the growth. Right, this was achieved while paying its high monthly distribution. It is a definite proof that data-driven call spread models can generate a net alpha and solve the NAV erosion problem. And then we have pillar 2, the tax alpha architect. Right, section 1256. Right, using this it gives you a 60% long-term favorable tax and 40% short-term capital gains rate. Right, you're saving a lot more money. And then return on capital, right? And this is tax deferred and reduces your cost basis, and it has not eroded the NAV, so that's a good rock. And then tax conversion, right? The deferred income is realized as long as a long-term capital gain. Tax lower only when you sell your shares. This is a 2-step arbitrage. I mean, if you don't sell your shares and you plan to pass it down, you get even more tax benefits. All right, the tax drag analysis, right? We have to look at what we keep. And as you can see, NEOS is absolutely destroying the Gen 2. And I would even put Gen 1, but there was no point. All right, comparing the effective tax rate on distributions, highest federal bracket, JEPQ's ELN create high tax ordinary income, while NEOS structure provide a clear structural tax advantage. You keep more of your money. There's no point of working so hard if you give it all away. And then we just do a head-to-head structural matrix with NEOS Gen 3, JP Morgan Gen 2, and Global X Gen 1, right? As you can see, Gen 3 is just much more, in their approach, they are much more flexible, and they are able to pretty much move upwards in a up market, move upwards in a choppy market, and pretty much hold pretty good in a down market. The Gen 2, they hold fairly well too in the down market, depending on the strategy. The JP Morgan cover call ETFs, they do hold pretty well in the down market. They are a pretty solid foundation. It's just what gets them beaten out is the tax advantages. They're not that tax efficient. And of course, tax and risk matrix, as you can see, yes, NEOS is the highest with expense ratio at 0.68, but we'll get to that later. Right, the false economy of expense ratios, right? Net annual loss per $100,000 invested, choosing JEPQ over NEOS. What does that mean by that? Right, on a $100,000 investment, 12% yield, JEPQ's 0.33% fee savings gain you $330. However, because of its the way their tax structure is, you actually lose money, right? If you actually had NEOS, you would have paid less in taxes. JEPQ would have actually cost you about $1,200 in taxes, whereas the 0.68 expense ratio, it's paid for. It's worth it. You save a lot more money. And then we have the NEOS Advantage. The NEOS is just not another income fund. It is a holistic design, third generation solution that was engineered to solve core problems of its predecessors, right? It solves the NAV erosion of Gen 1. It solves the tax drag of Gen 2. And on top of that, Gen 3 is giving a much higher yield. All right, that's it. This is a short video. It's not a deep dive. I just like that I wanted to make a video on this because NEOS seems to be everywhere. If you were to look for income related ETFs, NEOS is up there. If you were to look for a growth ETF, NEOS is also up there. So that just made me wonder. Guys, I appreciate it if you join the conversation. Subscribe, like, comment. Subscribe, comment, like. Yeah, I put the logos there, but I will eventually make these X account and all these Facebook stuff, but for now it's just YouTube. I appreciate you guys watching the video. Let me know if you agree, disagree. I hate comments, good comments. I appreciate it all. Thanks for watching. Stay tuned, guys.